Meeting is being recorded.
Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my privilege today to host and chair this meeting as part of the European Central Bank's listening tour, which is a serious effort by the European Central Bank to engage with the general public, with European citizenry and politicians, and with the expert community on a review of the European Central Bank's monetary strategy. We should, of course, see this in the context of not just the current issues facing the world, facing monetary policy and facing the euro area, but that all of the major central banks, or pretty much all, have undertaken in their own ways public reviews over recent years. Notably the Bank of Canada, the Reserve Bank of Australia, the Federal Reserve, and now the ECB. This strategy review covers all aspects of the European Central Bank's monetary policy. And today we will be featuring remarks and responses, most importantly, from Philip Lane, the European Central Bank's chief economist. We're going to be talking about the interaction between monetary and fiscal policies, the relevance and functioning of inflation targeting in general and in the euro area, issues of international spillovers and effects of monetary policy, climate change as part of the European Central Bank and other central banks' mandate, and make-up strategies versus forward guidance. We are very fortunate today to not only have Dr. Lane, but three others who fit with Philip Lane in the category of giants in both practice and scholarship about monetary policy. So in the order in which they will be speaking, we have Philip Lane, who joined the European Central Bank as a member of the executive board in 2019. He is responsible for Director General Economics and Director General of Monetary Policy. Before joining the ECB, he was the governor of the Central Bank of Ireland. He was Whately Professor of Political Economy at Trinity College, Dublin, where he founded and ran a very successful economic center, and of course made numerous academic contributions. He was a graduate of there and received his PhD from Harvard in 1995, and was an assistant professor of economics and international affairs at Columbia from 95 to 97 before returning to Dublin and then his academic career and becoming governor of the Central Bank of Ireland. In 2001, he was the inaugural recipient of the Brandeis Prize for outstanding contributions to European monetary economics. Speaking first after Philip's introductory remarks will be Stephen G. Cecchetti. Stephen is Rosen Family Chair in International Finance at the Brandeis International Business School. He was recently appointed Vice Chair of the Advisory Scientific Committee of the European Systemic Risk Board. Notwithstanding the overly long acronym, this is an important contribution to make to European financial stability and policy. For that reason, Steve will be speaking very frankly, as he always does, on a number of topics, but not directly on financial stability issues in the euro area. Before rejoining Brandeis in January 2014, he did a 5-year term as economic advisor and head of the monetary and economic department at the Bank for International Settlements in Basel. He previously had served as executive vice president and chief economist at the Federal Reserve Bank of New York, had been an editor at the Journal of Money, Credit, and Banking, and continues to blog very influentially at www.moneyandbanking.com. And delighted to have Steve with us today. He will be followed by Kristin J. Forbes, who is the Jerome and Dorothy Lemelson Professor of Management and Global Economics at MIT Sloan School. She has also served in senior policy positions from 2014 to 2017. She was an external member of the monetary policy of the Bank of England. And from 2003 to 2005, she was a member of the White House's Council of Economic Advisors. Prior to that, in the Bush administration, the second Bush administration, she worked in the US Treasury Department as Deputy Assistant Secretary. She also was, from 2009 to 14, a member of the Governor's Council of Economic Advisors for the state of Massachusetts. Kristin is one of the leading scholars of international capital flows, international finance, exchange rates, as well as monetary policy. And again, she's had an affiliation at times with the Peterson Institute, and we're delighted to welcome her back on this occasion. Finally, just going alphabetically, is Frederic S. Mishkin, the Alfred Lerner Professor of Banking and Financial Institutions at the Graduate School of Business at Columbia. From 2006 to 2008, he was a governor of the Board of Governors of the Federal Reserve System, as has come out in the minutes and records from that time. Rick was prescient in a number of his concerns and policy recommendations ahead of the worst of the global financial crisis. He's also been a senior fellow at the FDIC Center for Banking Research and past president of the Eastern Economic Association. He's taught at a number of places since receiving his PhD from MIT, including University of Chicago, Northwestern, Princeton, and then several decades at Columbia. He has also received an honorary professorship from the People's Renmin University of China. From 1994 to 97, he was an executive vice president, director of research at the Federal Reserve Bank of New York. I had the privilege to work for him at the time and got to participate under his leadership in the book, what became the book, Inflation Targeting: Lessons from the International Experience, which Rick co-authored with Ben Bernanke, Thomas Laubach, and myself. And that is, of course, since it's about Rick, I can say this, set the standard of a lot of the debate for inflation targeting in the 20 plus years since it was published. So again, we're very fortunate to have the combination of scholarly and policy expertise today. We're most grateful to Philip Lane and the leadership of the ECB for including the Peterson Institute as their American tour of the ECB Listens for the review of its monetary strategy. Philip, could I call on you to say a few words about the purpose of the strategy review and ECB Listens?
Thank you, Adam, and thanks to Peterson for organizing this event. I'm in listening mode today, so I look forward to the panel contributions later on. But it might be worthwhile just for your audience if I explain a little bit about the process in this review. So if you don't mind putting up my slides. And if you could just go to the next page, thank you. Okay, so it's been 18 years, which is a little bit long since the last review, which was announced in 2003. And so it is a little bit different maybe to other recent reviews, which have maybe been more direct in scope. Because what we've wanted to do here is really go root and branch, leave no stone unturned in terms of the whole process behind how we make monetary policy decisions. So it's all aspects. It's not just about what should be the aim. It's also about, what kind of monetary policy instruments should we use? How do we do the economic analysis in terms of understanding the world we live in? So it's been a lot of work. Let me emphasize it's been a Eurosystem project. So in addition to the work of the staff in Frankfurt, across the whole Eurosystem, there have been a lot of people involved in various work streams, working groups, a lot of joint authorship of a lot of notes, which I think has been good. And that includes also how do we engage with stakeholders. So today it happens to be me with you at the Peterson Institute, but we've had all sorts of events, whether that's ECB listening on a pan-European basis, but basically all national central banks have had a range of events. And we've also had interactions with the European Parliament, various civil society organizations and so on. And by the way, what has also been interesting were their own staff members. So in terms of internal town halls at the ECB, where we encourage people not just to speak as an expert, but also in terms of their own personal experience of living in the euro area. That was super interesting. So if we, and we do think has actually, I can tell you, it has been informative. We've actually learned by going through this listening exercise, and that is important. And I do think we have to incorporate listening on a more regular basis into how we do business in the future. Okay, next slide. So, just in terms of a time frame, we kind of mapped it out at the end of 19. I think we announced in January 2020, or we got going in the first seminar early 2020. But then the pandemic meant we did have to pause it for a little bit. But now, we're very active with lots of governing council seminars, and we're committed to finishing later this year. And essentially what happens is on a range of topics, they're brought to the Governing Council in a seminar format, and there's a lot of discussion of these topics, and then there's a dynamic process feeding back to the different working groups. Okay, next slide. Okay, so let me explain a little bit how it's worked. It is essentially, as is natural, you may want to start off by taking stock about, do we have a common understanding of our starting point in terms of the history of inflation, of monetary policy over the last 20 years of the euro. Then we move to, that's important, and let me emphasize that all of these is, that's not kind of considered to be a closed book. So we might have an initial stock take, but then you circle back. I mean, it makes sense to circle back as all these other topics get taken on, and then you might say, well, should I update my beliefs about the inflation narrative, the monetary policy narrative for the euro area? The second topic, of course, is when you try to think about price stability, when you try to think about delivering your inflation aim, you do have to go back to basic measurement questions. Do we have an updated view about any measurement issues with the inflation rate, and thinking about the underlying structural forces that might influence various influences on inflation dynamics. A third issue is, of course, an important topic, which is the European Treaty tells us to maintain price stability, but doesn't give us a particular numerical focus. In 2003, the decision was to focus on delivering an inflation rate below but close to 2%. And of course, we've been revisiting that topic in this review. Now, whatever you decide about what should be your inflation aim over the medium term, of course, how you deliver that is a question that in 2003 was a question about how do you set interest rates. But these days, when you do have an effective lower bound, when you do have a trend decline in the equilibrium real interest rate, we've already been using for 5 or 6 years other instruments, whether that's forward guidance, asset purchases, and targeted lending. So it's important in any strategy review to go over the pros and cons of different instruments, the combination, because they work together, and to update our thinking about, well, how do we use these instruments? What is a good way to make decisions about using these instruments? Okay, next, we essentially took on some kind of special topics. Every central bank in the world these days is thinking about climate change and monetary policy, and we folded that into this review. Now, in part, that is about just understanding our economic assessments. Do we have a good way of assessing the impact of climate shocks on the European economy? And I can tell you already in the last several years, it's been a non-trivial influence on quarter by quarter volatility in the euro area, hot summers, cold winters, and so on. But beyond that, clearly the carbon transition, we have a very strong policy orientation across the world, across Europe, in terms of having a lot of policies to support a transition to a net zero economy. And that transition itself is a major structural change for the European economy. which also has implications depending whether it's orderly or disorderly, for relative price dynamics, for reallocation, for equilibrium real interest rates, and for monetary policy. And over and above how it influences, if you like, traditional monetary policy considerations, it's also an open question about how climate change and the carbon transition should influence the design of our monetary policy framework, the design of the instruments we use to execute monetary policy. A topic which is, in the treaty is that the ECB needs to contribute to financial stability. And of course, that's quite a general issue. It's not just about monetary policy, because of course the ECB has their macroprudential policy role, amongst other attributes. But in this context, it is the intersection between financial stability and monetary policy. Let me emphasize is that's not just about the stance, about whether when and if and under what conditions financial stability might influence the appropriate stance of monetary policy. It's also about the instruments we use, because of course, in designing instruments, financial stability considerations can be taken into account. For example, in our targeted lending program, we have not included residential mortgages, and that might be interpreted as a consideration in terms of trying to mitigate the effect of a targeted lending scheme on the housing market, for example. So that's clearly an interesting topic for all sorts of reasons. And of course, with the pandemic, it was even more interesting, because a year ago, every central bank in the world essentially unleashed pretty major monetary operations, in order to avoid that this major shock to the world economy would be amplified by destabilizing credit markets, destabilizing financial markets. So, the pandemic is a vivid illustration of one dimension of this question. Now, behind everything, and maybe I'd be interested in the views of the panelists on this, is most of what goes into a monetary policy decision is the underlying analysis. Where are we? How strong is the economy? How robust are inflation dynamics? What are the influences of global factors, domestic factors? And also, by the way, in terms of calibrating policy, in order to properly calibrate policy, you have to have a good sense of the transmission mechanism of monetary policy. And of course, in a world where we use multiple instruments, not just interest rates, but also forward guidance, asset purchases, targeted lending, to understand how to calibrate those, a lot of economic and monetary and financial analysis is important. Next after that, another topic is monetary policy communications. Now, of course, one element of that is basically part of the toolkit, which is forward guidance. But over and above that, of course, in the last 20 years, the importance of how we communicate, the importance of new communication channels, the importance of influencing multiple different types of economic actors, not just financial markets, but also households and so on, is very important. It's been very important also, it remains very important for all sorts of reasons to look at monetary fiscal interactions. Of course, from word go, that's been very important for the ECB, because of course the treaty puts a lot of safeguards in terms of making sure that there's no monetary financing of fiscal deficits, for example. And of course, it's very important to have sustainable fiscal policies. But of course, on top of that, especially in a world near the effective lower bound and low equilibrium real rates, you also have to think about the macro role of fiscal policy, the contribution of fiscal policy in terms of counter-cyclical contributions. And that is, of course, very important in understanding the environment in which central banks work. And then let me finally just also come back to what is always a core issue for any central bank, which is the impact of monetary policy on employment. So regardless of whether a central bank has a dual mandate or a primary mandate, even with a primary mandate of price stability, the side effects of monetary policy on employment are very important. The treaty is clear about where we can, without prejudice to price stability, the importance of supporting the general economic policies of the EU, which of course includes full employment. So that's really, if you like, the kind of scope of what we've been doing. And you can only imagine on any one of these topics, you can divide those topics into subtopics and sub-subtopics. So it's been an incredible intellectual journey involving so many people. So it's really, I've learned a lot. I think that's probably, I hope, a sentiment shared by my Governing Council colleagues, that really we're learning a lot through this exercise. And as I said to you, it's all of these topics have been basically joint collaborations across the year system. So maybe I'll stop there, Adam, and as you know, as you indicated, I'll come back later in and try to respond where I can to the panel comments and the Q&A.
Thank you so much, Philip, for giving us the broader context and the whole breadth and depth of the work streams, as you put it. This is a very wide-ranging review. So as mentioned, we're going to have truly expert independent comments from scholar practitioners, from Steve Cecchetti, Kristin Forbes, and Rick Mishkin in that order. Their slides, their bios, and all that, along with Philip's, will be available on the Peterson Institute website, and obviously lots of materials linked to that on the ECB website. After those three speak, I will pose some questions to the three of them, Steve, Kristin, and Rick. We will then take some Q&A from the audience, and then a little before our closing time, I will invite Philip back in to respond to some of the questions and comments. Ideally, Philip will not completely fill that time, because we'll also offer the chance for our three speakers to say something to Philip. Anyway, that is the plan, and it's all going to go beautifully, just like central bank strategy. So in that spirit, let me turn to Stephen Cecchetti, please.
Thanks very much. As I try to share my screen. So first of all, thank you, Adam, for including me in this. It's a real privilege to be part of this event and to be part of the review, the extensive review. As Philip just said, there's a tremendous amount going on. I will comment on a very small part of this. I think it's an opportune time for the Euro system to be undertaking a review of its policy framework. The reason is not just that it was 2003 when this last happened, but over the last dozen years or so, the work of central banks has changed dramatically. In particular, the central bank today I see is using its balance sheet in ways and to a degree that we really wouldn't have imagined a decade ago, much less 15 years ago. And I think this raises a number of very important questions. And I'm not going to discuss the efficacy of the different policy instruments that are in use. This depends on a myriad of institutional and environmental details, of which I'm not particularly expert. Certainly in the euro area and the strains that exist in the euro area because of the number of different member states. Instead, I want to speak about the central bank policy framework in more general terms. And here I have really 2 points. First, the current framework, I think, that's used generally is incomplete in important ways. And second, I think central bankers need to seek to improve the clarity of how their actions are linked to their goals, what they're doing and why they're doing it. Let me acknowledge that that much of what I have to say is based on discussions and some joint work that I'm doing with Paul Tucker, and that will be published shortly. So starting with the goals, here's an exhaustive list of objectives: economic stability, financial stability, and government finance. I'm not claiming it's wise for central banks to do all these things. In fact, only under the most extreme circumstances like a war should central banks directly finance the government, although historically, of course, they did quite a lot of that. But looking at recent actions of major central banks, I think it's fair to say that that they've engaged in all three forms of this in one way or another. Now, turning to specifics of how it is that central banks use their balance sheets, I think that matters are currently somewhat in disarray. Starting in mid-2007, they found themselves responding to runs on both non-bank intermediaries and critical markets. This was true of all the major central banks. Then when COVID-19 hit, and governments desperately wanted to support households and firms, rightly, I want to emphasize, central banks again stepped in, and I'm not being critical at all. I think that that was, again, the right thing to do. And on the way, what the central banks have done is they've substituted themselves for private markets and institutions, as well as tailoring facilities to particular sectors or regions. Now, in thinking about this, Paul and I proposed this five-fold categorization of the purposes of central bank balance sheet operations. We're all familiar with monetary policy. We're pretty familiar with lender of last resort, although it's expanded quite a lot in recent years. Market maker of last resort has been less used, but more recently quite a lot. Selective credit support is credit steering operations where credit is directed to flow to specific sectors in the non-financial economy. And then there's emergency government finance, which is to provide needed funds directly to government. I think we can think of examples of each one of these. Asset purchases aimed at influencing financial conditions. This is really what I think we would now kind of everyone would agree as quantitative easing. It's the only thing that I would call quantitative easing. And most, but not all, of the outright purchases that we've seen, certainly by the Fed of treasuries and also of other central banks of sovereigns, clearly fit into this category. Lender of last resort actions are aimed at providing credit to financial intermediaries, including foreign central banks, that fit in here. These are things like primary dealer credit facilities, money market mutual fund liquidity facilities, and foreign international monetary authority repo facilities. All of my examples are, it's a little easiest at this point to just pick the Fed because they've done all these things. It's harder to categorize the Eurosystem actions. I'll talk about those in a second. Market maker of last resort actions, I think, have become more common. Here, I think the MBS purchases in 2009 and the secondary market corporate credit facility of the Fed in 2020 fit into this. Selective credit support has, unfortunately, in my view, become common as well. This includes things like large-scale asset purchases of MBS. The municipal liquidity facility of the Fed, which has fortunately not been heavily used, would be in this category, as would the Main Street facility. As for government finance, here I think while it's not well publicized, in my view, this is what the Fed actually did when it purchased Treasury securities at a rate that was faster than the US Treasury was issuing them. And as a result, during the spring of last year, the Treasury General account at the Fed rose by $1 trillion. It's running down somewhat now and creating some problems, but that's another point. Now, we can look at each one of these five and we can link it to the three goals. economic stability, financial stability, and what I would call quasi-fiscal policy. Now, importantly, of course, these are not exclusive. The tools can be used for more than one thing, and they can come into conflict, creating trade-offs. And so, I'm not claiming this as a clean set of categories, or that the tools would fit in them. Turning to the euro system. I think there's obviously standard monetary policy instruments, which include standing facility and refinancing rates, together with the collateral framework. Now, the collateral framework, I think, is an interesting case, because in my view, with its 25,000 plus eligible securities, at least on the public list, as someone has told me in the past, these have haircuts that go from nearly zero to almost 50%. And surely there's an impact on resource allocation in the euro area from this. This looks like credit support of a certain kind. And I think that this could sometimes be troubling. And it obviously has historical basis in the fact that the national central banks that joined together in the monetary union were doing things like this. But I think that the nature of this system should be part of the review. Now, the second thing I will say is that over the last decade or so, the euro system has put in place a broad number of measures. Here I've listed 10 types. In some cases, there are multiple programs. Like, for example, in the case of the covered bond purchase program, there are 3. Some of them have been started, stopped, restarted, and the like. I have nothing critical to say about any of them. My point, however, is that we should. I'd like to ask what they are. Surely each one of them fits into one of the categories Paul and I have. Which ones are aggregate demand management? Which ones are lender of last resort policies? Which ones are ensuring market function? Which ones are selective credit support? How can an outside observer know and distinguish the purpose of these? Does it depend on considerations like the relative level of haircuts or what? I think that we need to, it would be very helpful, I think, to understand this. My final point is that I think that this can lead us to a more comprehensive framework for central bank policy. And I believe that a legitimate policy framework has 3 parts. There's a mandate that delineates goals and responsibilities for every one of the actions, a governance structure with clear lines of authority, and a mechanism for communication and ensuring transparency and accountability. And on this last one, on communication, I think that ensuring accountability, and I think it's essential for policymakers to describe what they're doing and why they're doing it. And then I also think it's important to emphasize the risks that they face, and to explain how they're going to change what they're doing. One of the big issues right now is that we don't understand, or at least I don't understand, the reaction functions of central banks for their what they would call their non-standard tools. The list of programs that I have, what's causing them to increase, decrease, stay the same, lengthen in time, et cetera. And a comprehensive framework then for central bank balance sheet policy, I think, has every one of these for every one of the functions. It has a mandate, a governance structure, and a communication policy, and that generate a policy reaction function, or at least an understanding of it for everyone. Let me stop there, and I look forward to our discussion.
Thank you very much, Steve. It's great to have you bringing the focus onto balance sheets, which creates so much turmoil in communications as well as in operations, even if, as you say, it's been a necessary instrument. Kristin, to you, please.
Thank you. So Steve started by saying that central banking has changed dramatically. And we didn't coordinate, but I wanted to start from the same angle, just how dramatically central banking has changed and why it is therefore important to rethink mandates and focus. But I'm going to come at it from a very different perspective, including from an even more historic perspective to start off. This is Montague Norman. When I was at the Bank of England, my assigned seat in the Monetary Policy Committee room was directly under his glare. It kept me focused, but it also constantly hit me how things had changed. Back in the days when he was governor, supposedly he would decide to change the bank rate, the main policy rate. There was no press conference, no questions from pesky reporters, no attempt to be transparent and communicate. There was not any sort of monetary policy report or inflation report to discuss why they did what they did or what they saw, how they saw the economy evolving. There wasn't even a short 2-line statement saying they changed the bank rate. Instead, market participants would have to go do a transaction and then see that the bank rate had changed. So things have changed dramatically. A lot of that change, though, happened very gradually. It was sort of a slow evolution, not a revolution, as is not surprising given the sort of stodgy character of central banks. But since the ECB has been created, especially the last 15 years, these changes have accelerated and the changes have been quite rapid. So I think it makes a lot of sense for central banks to take a step back, think about their mandates and think about this whole set of issues as the ECB is doing. So they should be congratulated, but it is a big set of issues to tackle, as Philip's overview gave us an idea of. So I'm only going to touch, I only have 12 minutes, I'm only going to touch on 2 of those issues, 2 key developments in the global landscape that should be front and center as central banks think about how they should adjust their mandates to take into account these changes. One is structural changes to inflation dynamics, and second is the greater volatility and globalization of financial markets. So let me jump right in with the first one. Structural changes to inflation dynamics. So going back again to the old days at the Bank of England, monetary policy framework used to be pretty easy. You simply looked at this, this device. This still exists in the Bank of England in the courtroom, one of the formal old rooms, tells you the direction of the wind. And in the old days, the Bank of England, you would just look at the direction of the wind. The wind went in a certain direction. That meant ships would be able to get up the Thames and unload their wares at London. And that meant a big increase in transactions. So then you would have to expand the money supply because you were about to see a boost in activity. So you think back to those old days, monetary policy seemed pretty easy. More recently, central banks obviously have shifted their framework, and most central banks have been using something like this. Obviously, it's much more complicated, a lot of bells and whistles, a lot more complicated DSGE models, but at the core of the frameworks of central banks has been a model like this, a sort of Taylor rule combined with a Phillips curve assumptions, where you set interest rates preemptively based on the evolution of the economy that you expected to occur, and based on how much unemployment or output would deviate from what you thought was full employment, Y star, deviations of inflation, and then sort of a neutral interest rate in R star. So again, obviously a lot more complicated in practice, but these basic sort of relationships, interest rates set preemptively based on the evolution of inflation and employment and the closing of an output gap, were the key sort of tenets that determined how you set interest rates. And that worked pretty well for a while. But as has been highlighted recently, especially by Governor Powell at his Jackson Hole speech a couple of years ago, this model has been very hard to use recently because a lot of the model parameters have broken down since the global financial crisis, so since about 2008. In particular, some of the stars, what used to be pretty fixed parameters, have moved around a lot and been impossible to estimate in real time. And then also the relationship between how changes in inflation, changes in output gaps pass through into inflation, and then the optimal interest rates have also changed. So I'll talk about those parameters more in a few minutes. But the breakdown of the stars in the model, what used to be fixed constants basically, and then the way some of these changes spilled over into inflation and thereby interest rates have changed. So this model has become less and less useful. And so central banks are starting to think about what's next. What do we use if these core models, these fixed parameters just aren't as informative as in the past? So that has caused some central banks, led by the US, to shift to a focus that is less preemptive. We no longer can predict what's going to happen to inflation as well. We're less comfortable with our assumptions about these models. So we're going to wait a little longer. wait to see how the economy evolves, focus more on outcomes than predictions of where things will go, wait longer to adjust policy, especially if you're in a tightening cycle. So that has made sense over the last decade. If you look at how some of these model parameters were misestimated, if you look at some of our misunderstandings and how the parameters have changed. But what worries me is as central banks now rethink their mandates based on what they learned the last decade, they might be in a sense fighting the last war, because many of the errors and mistakes made the last decade and just things that took us a while to understand could reverse and go the other way. So central banks have to think carefully, not just about adjusting mandates based on what changed over the last decade, but what could change over the next decade. And let me be more specific about what that means. And what if all these parameters change again? And here I think COVID and the pandemic may actually cause some structural breaks and structural shifts and reversals from what we've seen the last decade. So let me be more specific. So in that simple sort of Taylor rule Phillips curve based model that underlies how most central banks think about the world, what happened in the period from the global financial crisis to COVID? And then I'll talk about what might happen next. But first, what happened after the global financial crisis? First, most countries underestimated the amount of slack in their economies. There was more room to lower unemployment, bring people back into the labor force, and that meant they could wait longer to tighten policy. One factor behind that was increased labor force participation, especially older workers in many countries came back, worked longer than previously believed. So that meant it was okay to wait to tighten policy because you had more slack than you believed based on former models. Similarly, our started fall, neutral interest rate had fallen quite a bit. That meant where interest rates were set was providing low levels, was providing less accommodation. So again, it made sense to wait to tighten monetary policy because the R star had fallen. It took a while to realize that. Not only did the stars change, but the relationships between what was going on in the economy and how that affected inflation and thereby interest rates had changed. So for example, inflation expectations were quite sticky. Inflation expectations were very well anchored. So even as inflation deviated, whether too high or too low based on the country, the year, inflation expectations stayed pretty steady. So what that meant is even if a central bank was slow to raise rates and inflation overshot, the impact with the cost was pretty minor because inflation expectations, again, were pretty steady. Similarly, a lot of evidence the Phillips curve flattened. Even as slack closed, as economies came close to full employment, maybe not as much in Europe, but in the US, the impact on inflation was much less than in the past. So once again, that meant that if central banks were slow to tighten policy, the cost was low. The impact on inflation was low. Put all these together, it meant that over the last decade, it made sense for central banks not to be preemptive, raising rates ahead of time, be patient, be slow, wait to get more information on how the models changed, how the parameters have changed. And if you were slow to raise rates, even as an economy hit full employment, inflation picked up, the cost was pretty low. You weren't going to slip into an inflationary cycle or wage price spiral. But now let's fast forward what's coming in the next decade. Obviously, who knows? I'm not going to pretend to be a great forecaster. There's a lot of uncertainty, but I think there are also some good reasons why COVID and the pandemic may affect all these parameters again and possibly push them all in the opposite direction of what we've seen the last decade. So more specifically, last decade, we saw increased labor force participation, more slack than we understood was out there. But going forward, there are some reasons why you might see less of an increase in labor force participation. There's already evidence that older workers dropped out of the labor force the last year. Makes sense. They're more worried about health risks around the pandemic, but it's unclear if they'll come back. If you dropped out of the labor force right around retirement age because of concerns about a pandemic, especially if you had some money stored away, not in savings, but in financial markets, your net worth has gone up. You may have less incentive to come back to the labor force, unlike after the global financial crisis, where your net worth was decimated. So you had to come back and work to have a certain amount of savings to fund retirement. That's not the case. So we may not see all the labor force come back the way that's expected. Our start has fallen. Neutral interest rate has fallen quite a lot. There's been a lot of discussion about why. There are some arguments, and we hear a lot about it at MIT and some companies I've been talking to about how productivity growth could accelerate the next couple of years as companies have been forced to adopt new technologies, new ways of doing business because of the pandemic. You hear from a lot of companies, they've now done 10 years of technological innovation in 10 months, and they were forced to do it because of COVID. That could affect our start. There's some work by Goodhart and Pradhan about how demographics could raise our start going forward. I don't know. Our start has fallen a lot. I have no confidence in any predictions of where it goes next, but I think there are now more risks that it will at least stabilize or increase rather than continue to fall, as in the last decade. Inflation expectations have been well anchored. That's helped minimize the risks of being, say, too slow to tighten rates. But as inflation now is picking up quite quickly, we're seeing headline after headline about the fastest rate of inflation in 15 years. Even if this is just temporary factors, even if the factors driving up inflation now dissipate in the next year, this could affect inflation expectations. There's now a young generation that hasn't seen high inflation that is now seeing prices pick up quite quickly for where they spend a lot of their money. So it's not clear that inflation expectations will stay as well anchored and as sticky going forward the next few years as they have been in the past. I don't know. And finally, evidence the Phillips curve flattened over the last decade. But there's also some nice academic work, including at the PIIE by Chris Collins and Joe Gagnon. And then I added on to some of that work, adding in some global factors. But all this work suggests that the Phillips curve is nonlinear and is kinked. Phillips curve is very flat when you have a lot of slack, which has been a lot of the last decade. But as that output gap closes, as there's less slack, then reductions in slack will transmit into higher inflation at a more rapid pace. And here's a graph from a paper that Chris and Joe Gagnon did showing this kink in the Phillips curve. In countries like the US, where there's a good chance the output gap is closed by the end of the year, you could see this relationship between unemployment and inflation pick up and be stronger than we've seen in the last decade. Europe has a little farther to go before they hit that point. But I think the main point is that each of these relationships, which was important in allowing central banks to be slow, not act preemptively, take their time, feel out how the economy has changed, made sense given the structural changes that happened. But it's not clear those will all carry through. So what's that mean directly for the ECB's mandate review? Uncertainty will continue. We are not going to have a good idea of where the parameters in our inflation models are for the next decade. It's very hard to estimate these things in real time. So central banks are going to have to continue to sort of feel things out. It's going to continue to be hard to act preemptively. Even if economies do bounce back and recover, it does make sense to wait, feel out how much slack there is, how is inflation evolving, is the increase in inflation sustainable? But that also means there's a good chance central banks will be behind the curve whenever they hit that point where they should be tightening and removing the massive amount of accommodation that's out there. So what's that mean for mandates? What I'd suggest that would imply is that central banks do need to maintain their ability to be nimble and flexible. Try to cut down reliance on forward commitments, whether it's a lot of long-term guidance, whether it's committing to asset purchase programs or other programs that last a long time. Try not to lock yourself in because it's very hard to know how these parameters will evolve and you need to be flexible. That also means adjusting communication that even though you will provide accommodation as long as needed, that when a change is needed, you might need to act quickly. There might be faster adjustments that come so that market participants are ready that whenever the day comes to tighten interest rates and QE, all of that, adjustments might come down faster than we saw over the last decade, because there is a chance that the actions could come later than you normally would have done if you could have hit a preemptive model of inflation. Since those models don't work, it might mean faster adjustments. And then finally, in terms of the specifics of the mandate, price stability mandate, inflation below but close to 2%. What's all this mean for that mandate? My sense is the current mandate probably doesn't need major changes. It does make sense to be symmetric. I think we have seen that the risks of inflation being too low can be just as big as inflation being too high. So shifting to a symmetric inflation target seems to me quite sensical. Other changes being suggested, such as shifting away from focusing on inflation to focusing specifically on employment or maximum employment, I don't think that's really needed. A couple of reasons. One is if you're focusing on medium-term inflation or sustainable inflation, employment's automatically in there. For example, the Bank of England, we hit a 2% price stability mandate, but we focused a lot on employment and output gaps, because if you haven't closed that output gap, or what's happening in employment dynamics is critical for what happens to medium-term inflation. So you don't need to put it explicitly in there, it's already in there. And if you start to put explicit language in there about unemployment, output gaps, then you raise the issue of how do you measure that? Focusing on just unemployment isn't a great measure of output gaps, because we know there's a lot of other variables that come into assessing if there's slack in labor markets. Participation, hours worked, especially with a sharing economy or for people work from home. Your exact numbers are hard. You really need a sort of dashboard of employment statistics, and that gets hard to communicate. So that's why I think sticking to just inflation makes a lot of sense. Employment's in there, slack is in there. You don't need to muddy the waters. Better measure of inflation than the current one. Again, I don't think that's a first order importance. Something, as long as you're focusing on something like a sustainable inflation, a core measure inflation probably makes a lot of sense. But if you're focusing out 2 years or medium term, that gets around that. And then just the broader inflation measure is easier to communicate. So I'm not sure there need to be a lot of tweaks on the exact language, except maybe shifting to more symmetric focus. So second set of changes in the global economy, I will do more quickly, but I think should be front and center in a mandate review, is just how financial markets have become more volatile and more global. We've all seen headline after headline, this was the biggest move in X market in ever. And then a week later, you had the biggest move ever. And this has happened again and again. And financial markets are increasingly moving, not because of something that happened in your own specific country or region, but something that happened halfway around the world. So financial markets, more volatile in the past, more global, and this is forcing central banks to step in very different ways than had occurred in the past. Skip that. But this is forcing central banks to take on a whole new set of roles. It's financial market stability, liquidity are increasingly on their plate. Central banking is no longer mostly about tweaking interest rates to get inflation and growth back to certain levels. Financial stability is more and more, what is being discussed and on the table. So some of these new roles are using similar language to Steve. Central banks are no longer just lenders of last resort, but they're market makers of last resort. They're liquidity providers of last resort. Similarly, because of this financial stability role, liquidity provider role, central banks have had to greatly expand the types of tools they use in the facilities they are in charge of. It's no longer about tweaking policy rates. It's no longer just about asset purchases. It's about buying assets, not just of government debt, but of corporate debt, some countries' ETFs. It's about providing liquidity to different types of institutions. It's about providing banks with subsidized lending. It's about providing guarantees for certain markets. This is a huge expansion of the types of tools and facilities central banks have traditionally used. And most of these are not about getting inflation back to target or price stability. These are about financial market disruption and financial market dislocation. Granted, these are related. You need financial markets to be functioning for a traditional monetary policy to affect the economy. Granted, an economy is not going to get inflation back. You're not going to get price stability, full employment, if you don't have fix some of these major dislocations in financial markets. But the main reason for these new facilities and tools are financial stability and liquidity reasons, not price stability. And then a lot of these new tools have involved more coordination with fiscal authorities, especially some of these liquidity programs, credit programs. The government is the guarantor of last resort, or gives financial backing for these programs. So these new roles raise a whole set of questions, which I think should be part of any discussion of mandates. As central banks take in these new roles, what markets should they support? What qualifies as dislocation? Central banks obviously should not just step in because markets lose value, but how much is enough to require their intervention? And if central banks are being expected to step in when there's big falls in markets, how do you reduce moral hazard?
Kristin, I'm terribly sorry, but I need to ask you to wrap up.
Okay. New facilities, who bears the risk? How do you unwind them? And then how much coordination with fiscal authorities? What if the objectives don't align? So huge questions. I will actually put those off, especially as I'm out of time, and just put in a little plug for a book that's coming out in a week and a half by the CEPR. This is edited by myself, Bill English, and Angel Ubaid. This is a book that collects chapters by 16 major central banks on what they did in response to COVID, including a chapter by Philip Lane. And it has some overview chapters that really drill into these questions I just raised in more detail. So last slide then is, what's all this imply for the review? I would suggest really highlighting financial stability front and center. This is, even though there's institutional issues and different groups in charge of financial stability, the ECB, you need to make more active use of macroprudential tools. The ECB monetary policy group has to clean up when there's financial stability issues, so they should have more involvement in the mechanisms put in place to avoid the need for them to clean up. That means expanding the regulatory perimeter, not just about banks, but about broader market issues. The ECB should be thinking about making some of these new tools more conventional. They're now used more often. They shouldn't just be secondary to raising and lowering a policy rate. We saw that during COVID. ECB made minimal use of adjustments in its policy rates. It shifted to the other tools. How should those be used together? How should they be coordinated? When to use one, when to use other? If you use certain tools for financial stability, then can you unwind those without having affecting monetary policy and monetary stability issues? How do you unwind large balance sheets if they become big for financial stability reasons, not monetary policy reasons? And then finally, coordination. Obviously, central banks have to take into account what the fiscal authority does. There's more burden on them as interest rates are low. But it's not clear you need more explicit coordination on the monetary policy fiscal side. I think where the most interesting debate is coordination of fiscal authorities on the financial stability role played by central banks. That's where there has had to be much more joint work and joint action. And how will that work if the fiscal authority and monetary authorities are then heading in different directions in the future? So just to summarize, a lot has been happening around the world, a lot of changes in central banks. I just touched on two, but I'll look forward to more.
Thank you.
I'll stop there.
Thank you, Kristin. The allotment of time for each speaker was 12 minutes. I'm just trying to be fair. In that mode, let me turn now to Frederic Mishkin of Columbia University, please.
Hopefully you can see my screen. Am I correct?
Yes, we can. Thank you, Rick.
Great. So I want to talk about the issue of basic monetary policy strategy and argue that the ECB really needs to make a major shift in the way it does inflation targeting. I'm actually going to be quite critical of the 2003 review. I think it was not particularly successful, created some problems. And hopefully talking to people at ECB listening will result in a better outcome in this case. By the way, Philip, I will also criticize the Federal Reserve, so don't worry about it. I'm going to be an equal opportunity offender here. So there are two really key lessons that we've learned since the global financial crisis, and they're very important in terms of thinking about how we need to modify the inflation targeting regime. So the first is that the effective lower bound constraints, it used to be called the zero lower bound constraint, but we know that you can go a smidgen below zero in terms of policy rates, that it actually binds much more often than we expected. In fact, we spent many, many years in this constraint, and we're back in it again in the US and in the Eurozone as well. And so why has this happened? There are three reasons. One is the economy is can be much more nonlinear than previous models were suggesting. This is what I call the over the cliff phenomena. that this is exactly what happened when we had financial disruption in the global financial crisis, because these shocks can be very huge and very nonlinear. And of course, the other thing that's been mentioned, that Kristin mentioned quite a bit, which is this whole issue that natural rate of interest has fallen, that the real equilibrium interest rate, which puts you at full employment, is much lower now than we thought before, and we're not even sure why. So that's actually a real problem in terms of thinking about policy. And the second lesson is that once you hit this effective lower bound, it's much harder to stimulate the economy. Yes, we have tools, these non-conventional policy tools, but they're much less effective than hoped. And in fact, one of the key things that a dilemma for central banks, something that I never expected when I started doing research in monetary economics over 40 years ago, is that we were always worried about inflation being too high. But in fact, the big problem for central banks right now has been that inflation has been too low, and it's very difficult to get it to rise to target levels. So these are two key lessons, and it really makes you have to rethink the inflation targeting framework. So the first issue comes up, which is, should you raise the long-run inflation target? And we know that prominent economists like Olivier Blanchard, when he was at the IMF, suggested maybe going up to 4%. The theory for this is completely reasonable. But I'm going to argue that the practice is not, and this is, of course, very much in line with what most central banks think. And I'm going to be very quick on this because I don't think I need to convince Philip and the ECB that they shouldn't raise the inflation targets. And of course, the idea here is that with a higher effective lower bound, then you're in a situation where you're less likely to hit that lower bound. And in fact, monetary policy has more room with conventional tools to actually be stimulatory. So, for example, if you have a 4% inflation target and expectations of inflation of 4%, then you can go down 400 basis points in terms of the nominal rate more in this case. And so in this situation, you can actually get a minus 4% real interest rate, while if the inflation target is only 2%, as in most countries, then in fact, you can only get a real interest rate of minus 2%. So less stimulation, and that creates serious problems. The problem, of course, is that in practice, this is a terrible idea. So it's much more difficult to stabilize inflation at higher levels. That 4% is not really consistent with what the Greenspan definition of inflation, which is you know it when you see it. And in fact, as a result, it's not clear why you should choose 4%. Why you should choose 4? Why not 6? Why not 8? And so we could really go back to deja vu all over again. Go back to the 60s. Where in fact they used to think that inflation maybe it could go higher to 4 to 5%. You could actually lower unemployment that way by exploiting the trade-off between unemployment and inflation, and that turned out to be a disaster. It led to the Great Inflation period. And also clearly, one of the great successes for central banks in the last 20 years is that they've anchored inflation expectations, and giving that up would be a terrible thing to do. And finally, there are actually additional cons that even though raising inflation target may have short-run benefits, it produces a lot of distortions in the long run. And so adding those up every year could actually be big numbers. So the bottom line is I don't think any central bank in the world thinks that raising the inflation target to a higher level is a great idea. However, it is true that we have to think about the symmetry of inflation targeting. And Kristin mentioned this, and this is where I'm going to actually be quite critical of the ECB and quite critical of monetary policy in the last 10 years or so. So should inflation targeting be symmetric? Absolutely, yes. Kristin mentioned this. I always refer to this as that the ECB should not fall into the Chanel fallacy. So who is Chanel? Not the perfume. She was a famous fashion designer who said you can never be too rich or too thin. So maybe you can't be too rich, but your kids certainly can be too rich. But certainly you can be too thin. We call that anorexia. And the same issue occurs for inflation. Can inflation be too low? Absolutely, yes. It's been a big problem for central banks throughout the world in this current situation. And in fact, here's where I'm going to be quite critical of the 2003 review. I was very unhappy with the outcome from that. In fact, I had a lot of discussions with Lucas Papademos about it, and he knew exactly when he was an executive, when he was, a vice president at the ECB. What did they do? They had this long involved review, and they came up with an inflation target as basically a little below 2%. And I think this was a huge mistake, and it was a very big mistake for several reasons. The first is the suggested asymmetry of the inflation target, that you were fine if you were below 2, but only had a real problem when you're above 2. And in fact, I think this actually led to serious policy mistakes by the ECB. You see a divergence. During the global financial crisis, the performance of the ECB and the Federal Reserve were fairly similar. The path of the economy is very similar. There was a divergence after that, starting in about 2010. And in this case, what happened? Well, the Federal Reserve lowered the policy rate to 0, and the ECB did not. They kept it a little bit above 0. But even more importantly, they made a serious mistake in April of 2011 when they actually raised the policy rate. And that was very problematic from a point of view of expectations about what the ECB would do in the future. And I think this is one reason why the performance of the Eurozone economy diverged from the US, did much worse. There are other very important reasons as well. Maybe even more importantly is the failure to recapitalize the banking sector in the Eurozone. But nonetheless, I'm quite critical of the ECB's policy. And I think it came out of a mistaken view of the way they described the inflation targeting regime. In fact, by the way, this issue is one that Ben Bernanke and I had talked about in a paper that we wrote that was a precursor to our inflation targeting book that we worked on with Adam, that we said that there was an asymmetry for the Bundesbank, which basically tended to worry too much about overshoots and not enough about undershoots. And indeed, I think that the ECB was supposed to inherit some of the credibility of the Bundesbank. They even put the ECB in a city that many people were not happy with, which is in Frankfurt. There are a lot more exciting places to live than Frankfurt, Germany. But why was it done? It was because the ECB was supposed to be like the Bundesbank. And in fact, in this case, I think that they ended up with a similar kind of asymmetry to their inflation target, which I think has been very problematic. So I'm going to have two recommendations. My first recommendation to the executive board at the European Central Bank is that the ECB should change the inflation target to 2% and emphasize, and say not a little bit below, but say 2%, and emphasize that it's a symmetric target as the Fed has done. So the Fed basically started with a 2% number. It then realized it should clarify that it was symmetric. This also has an advantage of much simpler communication. 2% is much better than saying a smidgen below 2%. So very important that they get rid of this asymmetry. The second issue is the issue of average inflation targeting. So this is something that's been discussed quite a bit in the economics literature. The Fed actually adopted it in August of 2019. Why did they adopt it at that time? They were worried that there was a continual undershoot of the 2% inflation target, and that might lead to an unanchoring of inflation expectations. You're continually below 2, inflation expectations might fall below 2%, and that actually would be serious because it would indeed make the effective lower bound problem even worse. So this is something that they realized is very problematic. And by the way, the ECB has had exactly the same problem. So average inflation targeting fixes this. Why? Because it does not treat bygones as bygones. It actually says the past matters. Mike Woodford has described this as saying it's a history-dependent policy. Why? Because low inflation in the past requires temporary higher inflation in the future, and that means that you actually temporarily target for inflation above 2%. So, for example, if inflation had been running at 1.5% for several years, then monetary policy would aim for 2.5% for several years. And just to see that this is what it looks like, that if you had you're at the 2% target, you have a negative shock like the GFC or COVID, inflation is going to be below your 2% target. Then the traditional inflation target is the green dots. You just keep on shooting for 2%. It doesn't matter what happened before at time t. You just keep shooting for 2%. However, average inflation targeting says, no, you've got to compensate to get the average be 2% by temporarily raising inflation to above 2%, let's say 2.5%, and you do that for a period of years to get the average to 2%. So very importantly, the economics literature has described why this is also important from another perspective, which is that it leads to very desirable expectation dynamics. And that results in less output variance. In a sense, it creates an automatic stabilizer. So here's why. If you have a negative demand shock, then inflation will fall below 2%. That was what I just showed in the picture, which requires raising inflation temporarily above 2% for a period of time. So in this case, for the period of time that you're telling people you're going to raise inflation, expected inflation now rises above 2%. And that's exactly what you want to happen, because at the effective lower bound, where let's say it's 0, but it's effective lower bound, then you now actually can't lower nominal rates. So you actually then end up lowering real rates by raising inflation expectations. So therefore it stimulates economic activity automatically, exactly what you want to have happen. And so it's an automatic stabilizer. A negative demand shock leads to stabilizing expectations. And by the way, this is clearly very important when you have the effective lower bound. So here's where I want to, since I give it a hard time to the ECB, I want to beat up on the Fed. So I've been actually very unhappy with the Fed's communication strategy. Maybe we'll get to discuss this, Steve. It's related to the issue of how you do forward guidance and the need for talking about the reaction. You described reaction function. I like to call it reaction process, because Mike Woodford said you can't write it down in an equation because a lot of it's anecdotal or judgment information. But the key thing in terms of what the Fed has done is they have not specified how long a period we actually use to calculate the average. The Fed has been very unwilling to be transparent about some of these issues about reaction functions or processes, been unwilling to basically clarify this because they don't want to be pinned down. But I think this is a real problem. So just to see what the problem is, if in fact you choose a very long horizon, so you say 20 years or it could be infinite, it means that effectively you've just gotten rid of the inflation target. Because if you do it over a very long horizon, you can keep inflation above 2% for a very long period of time. And in fact, this is something that I've criticized in some of my writings. It's actually a very big problem. Why? Because you now can unanchor inflation expectations in the positive direction. And we know that's a very bad thing to do, that it leads to higher inflation and output volatility. So how do you fix this? You just specify a number of periods, which tells the markets how long inflation should be above 2%. You can change that given different conditions to make it flexible, but you've got to provide much more information. Right now, Fed's average inflation targeting is to me a weakening of the actual inflation target. So here's my recommendation too, and I'll be finished shortly, which is the ECB should adopt a 2% average inflation target, where the average is over a specified period, and there's several choices. You could say 5 years, for example, or you could do what the Australians did, said over the business cycle, which is maybe a little bit longer, who knows exactly, but it gives more information. Or basically since the effective lower bound started. That's Ben Bernanke's proposal. Very importantly, also, you should clearly communicate that average inflation target is still a very strong commitment to a long run target of 2%. So you make it very clear that you are not weakening the commitment to an inflation target, and then that you very clearly want to keep inflation expectations anchored at 2%. And by the way, this is not pie in the sky type of stuff. It actually has been the style of the way inflation targeting was done by the Reserve Bank of Australia, starting in 1995, which they said we want to have an inflation target with between 2 and 3%. I would have preferred they say 2.5% on average over the business cycle. And economic performance in Australia has been really excellent. Average inflation since 1995 has been very close to 2.5%, the midpoint range. And they didn't have a recession for over 25 years until COVID. So the bottom line is that I think that the ECB really needs to rethink its monetary policy strategy, come up with a simpler and symmetric formulation of the inflation target. And secondly, should adopt average inflation targeting, but in fact put more clarity on it than the Federal Reserve has been willing to do. Thank you.
Thank you very much, Rick. So we are going to go to questions, and this is all on the record. Just to remind people, please don't raise your hand. Please file your questions under the Q&A function on Zoom if you are a registered guest. I will be collecting them. I'm going to make 2 remarks myself and then put a couple questions to our speakers. And after we gather a couple more questions, we'll bring Philip back in. So I just want to say that I'm much more in the camp with Rick. I think the room for criticism of the ECB's strategic framework and how it's been operationalized is much bigger than the tone that is generally affected. When Rick, Ben, and I first wrote about inflation targeting, or were not the theory papers that Ben and Rick did, of course, but I was not part of that. But when we wrote an op-ed in the Wall Street Journal about inflation targeting, we raised essentially the weekend at Bernie's problem. We weren't allowed to publish it, but basically, if Alan Greenspan dropped dead on the tennis court, what would anchor inflation expectations? And the idea was that we wanted to get away from personalized policy. And what we've seen with the ECB is a major shift in policy, first under Mario Draghi from Jean-Claude Trichet, and then a major shift in policy under Lagarde, Lane, Schnabel, de Guindos et al. But no change in stated target and no change in stated operating procedures. Now, of course, there is to be some variation of preferences as people and circumstances change. That's in the nature of central banking. But I think it is a weakness in the system that there has been so much swing based on who's in charge, and that there's been so little explicit acknowledgement of the failings of some of the earlier regimes. I think going further, and this is a place I differ from Rick, I know, and I differ from most of the mainstream. I think resetting the inflation target upwards is valuable, not just for the theoretical reasons Rick said, but in practice. Rick recapitulating Olivier Blanchard and others. Because if you go back to the inflation targeting book we wrote, we posited, looking at New Zealand, Bank of Canada, Bank of England, that with assent from the elected officials, central banks should be able to reset their inflation targets more than occasionally based on changing circumstances and changing state of knowledge. And there was always, of course, the worry that if you kept resetting it every time, it might spiral upwards. But instead, we've ended up with an equilibrium for 20 plus years where central banks almost never reset their inflation targets. And inflation targets became like exchange rate targets, that if you set a peg what was supposed to be a range, you would end up having a ceiling or a floor where all the outcomes would congregate, and people would be scared to move that ceiling or that floor for fear of looking incredible. And I think that this is a malfunction and against the spirit of what inflation targeting should be. And I think if you're going to play this game with average inflation targeting, I don't understand why that's any different than saying for the next 4 years, our inflation target should be 3%, which removes a lot of the issues about uncertainty, credibility of commitment, and communication. So to me, as Joe Gagnon, Olivier Blanchard, and others have pointed out, I think we should take advantage of this, and this applies to both the Fed and the ECB. I think a second point to raise, and again, relating to some of the things Rick said, but also, of course, Kristin and Steve, is the issue of how much we've undershot inflation for how many years and how many forecasts were wrong. And I know that Philip has been, along with the senior team at the ECB, have been very forthright about this. But I think it's time that the ECB recognizes that the Fed, I think, quite usefully has in its strategic review over the last couple of years, that focusing on R star, U star, and other unobservables is a mistake. And this, of course, Kristin talked through some of these issues and I think came out probably sympathetic to this approach as well, although she warned that we may be switching to an environment where that kind of approach is past its time. I think that's a debate worth having. But for me, the overwhelming repeated failures to achieve inflation, even in environments where there was enormous quantitative easing, enormous fiscal laxity, enormous uncertainty, tells you that the vertical Phillips curve leaping inflation expectations models that underlay inflation targeting circa 1999 or circa 2003 are more fundamentally wrong than we care to say. Or have cared to say. And so I think the Fed leadership right now has done the right thing by moving towards its less preemptive strategy. And I think the ECB, it won't, but I think it should consider that. A third and final point I would make is on the question of divergences. And this is something that the Euro area has to cope with in a way that the US monetary zone or the Japanese or the British monetary zones do not. That doesn't mean there aren't divergences within these countries, but it means for political reasons in both the popularity sense and political reasons in the constitutional sense, we have much more serious implications of the underlying divergences in the Euro area than we have in any of these other major monetary zones. And the weighting of inflation rates across national entities, the weighting of economic outcomes across national entities, these are Hamlet without the prince if we tell the failings of the ECB without making any acknowledgement of these. And the ECB has been pushing both behind the scenes and slightly publicly for better fiscal integration and better fiscal redistribution in Europe, which I commend. But in the end, a euro area that does not confront longstanding divergences in prices and income and productivity is one that is inherently fragile. And I wish the ECB would think about how to take that into account. Anyway, that's my 2 cents for what it's worth. I know people are here to primarily hear from Philip as well as our 3 distinguished guests. I ask our viewers understanding that Rick, Kristin, and Steve all know that the officials get listened to more than the academics once they're out of office, even when it's Rick and Kristin and Steve. But I'm going to pose some of the questions that have come in to our panelists before turning to Philip, because I think their points of view are also important. So let me start off with Ignacio Angeloni and others have raised the issue of climate change. And Philip featured that in his opening remarks, and President Lagarde has, of course, mentioned that quite a bit. I'd like to just get a quick lightning round from each of you what you think the ECB is doing on climate change, if you've thought about it. If you haven't thought about it, don't worry about it. But if you have thought about it, how central should this be and how should they treat it? Steve, let me start with you, please.
Thanks very much, Adam, and it was fascinating to listen to everyone else and their great comments. I think that there are 3, you can think of 3 things that a central bank can do. There's balance sheet policy, there's financial regulation and supervision. I'm going to leave the second and third to the side. Those are very much involved in climate policy. So the question really, I think, comes down to whether or not balance sheet policy should have a climate policy component. And here I think that that quantification, deciding what to buy or what not to buy, deciding on how to handle things in your collateral framework, these things are going to be very fraught. Quantification is going to require drawing lines, deciding what's green, what's not. And everyone's going to complain, and your independence is ultimately going to come under attack. So I very much support regulation and supervision, ensuring that climate risks are properly dealt with on the balance sheets of financial intermediaries. But I caution against trying to integrate it into the balance sheet policy of the central bank itself.
Thank you, Steve. Kristin, do you have any thoughts on the climate change issue?
I think I come down to a very similar place as Steve. Climate change is important for financial stability issues. So when you're doing the financial stability analysis, you should take into account what's going on with climate change. Just like when there's changes in tax policy, you need to think about how that affects the economic outlook when you're doing your forecasts. But telling a central bank to directly take action to directly address climate change, I worry about. Central banks just don't have effective tools. There is already far too much on their plate. They're expected to do a lot. I would rather see them sort of stick to their knitting, really focus on the areas that are directly in their mandate where they do have the most effective tools to address them, and let very important issues like climate change and a whole host of other issues that are very important have them addressed by government authorities or places that have better tools to do so.
Thank you, Kristin. Rick, do you want to add anything on climate change?
On the climate change issue, I'm going to be somewhat boring because I'm just going to agree with Steve and Kristin, but add that there's an important issue here, which is, yes, you have to worry about climate change as it affects financial stability. If there's an issue that you have storms that cause a big disruption to economic activity, these acts of God, of course, you want to pay attention to that. But it's the problem that we're now facing for central banks is that they're in a big danger. They're in a very dangerous situation where their remit looks like it's expanded. So central banks are now actually buying private securities, as the Fed started doing during COVID, getting involved in lending to small businesses. Climate change, they're being asked to deal with inequality. That climate change as a part of the remit of a central bank, I think would be a terrible thing to do because it really does weaken the independence of the central bank if the central bank is viewed as getting involved in issues where the government should actually be deciding it. So I'm very much in agreement with that. Let me just briefly mention 2 issues that Adam mentioned. Adam, we agree that average inflation targeting is identical to saying, if you have a horizon of 5 years and you've been at 1.5, then you want to go and specify that you want to be at 2.5 for a period of going forward. It's identical theoretically. From a communication viewpoint, I think that there is a problem saying that we're actually raising the inflation target, because it's very important that people realize that commitment to an inflation target at a particular level is in fact really sacrosanct. What the level should be, actually, I would not have a problem with a slight rise in the inflation target. I take the view of the Greenspan definition, which is, inflation when you see it is between 1% and 3%, and we should be at the higher range. So we don't disagree there. One issue that you've mentioned, but also Kristin mentioned, is this issue about being less preemptive. And I think that's right in a sense, but wrong in another sense. Less preemptive, we know this is coming from the work of Brainerd, that when there's more uncertainty, you actually react less. And in that sense, I agree with both Kristin and Adam that we may have to wait to provide more information on some of our key parameters to decide what to do. But it really depends on the shocks. So for example, during the GFC occurred, and in fact, central banks were not preemptive enough. So I was on the board at the time, and this was in December of 2007. And I actually, I'm on record in the meeting that I wanted to dissent because I thought we were too far behind the curve, had discussions with Ben about this, and decided not to dissent because there's a problem. If a governor dissents, it looks like they have no confidence in Ben. I had a lot of confidence in Ben. And by the way, to Ben's credit, 2 weeks later, or actually a week later, he said to me, Rick, I think you were right. So actually there are cases where you need to be even more preemptive. COVID is a classic example of where they got it right. Basically, luckily, the good news about COVID is that it didn't occur before the global financial crisis, because basically central banks learned that they shouldn't wait. They should be more preemptive. And in fact, it was remarkable. Within 2 weeks of the pandemic being declared, the Federal Reserve basically implemented all the programs that they had before, and actually then did actually more lending on steroids, both to the private sector. So I think you have to be careful when you say less preemptive. It really, let's follow the Brainerd principle, but realize there are shocks where, if anything, we have to be more preemptive. And I think central banks have learned that lesson.
Thank you very much, Rick. I will not pretend to waste people's time. Let me go 2 other quick questions and then get to Philip. A number of people have raised prior to this the issue of yield curve control as an instrument. The Bank of Japan, some would argue, including myself, that yield curve control has been very successful there. There are issues in fiscal monetary coordination in certain circumstances that we don't seem to be facing right now where that might seem good. And the Federal Reserve Board, the FOMC has been careful not to rule it out, but not say they're actively considering it. Kristin, Steve, Rick, or let's do it, Kristin, Rick, Steve, just to mix it up. Are there any circumstances under which you think the ECB should be engaged in yield curve control as part of their toolkit? And does it matter that they're not a national central bank?
So I'd say quickly, no reason to rule out any tool. There's no benefits, keeping as an option, and who knows how the world will evolve in the future. But it's hard to see that being a top priority right now, or how that makes a lot of sense right now, especially back to some of my comments I focused on, given that it's hard to set policy preemptively, given the instability and all the models we used to rely on, you need to be flexible. And so locking yourself in advance in yield curve control feels like something that could be too much of a handcuff and remove some of the ability to be flexible going forward, given all the uncertainty that exists right now. So I don't see the case for it right now.
Thank you very much. Rick or Steve, do you have any differences of opinion?
Nope, I agree with Kristin.
I agree. I just add very quickly that that if you do use yield curve control, you've got to figure out how to get out of it. Lael Brainerd has a clever way of getting out of it, but it's kind of complicated. Just to target a particular maturity that then rolls off. So I think that the mechanics of it are difficult as well. Again, you don't want to rule anything out, but right now doesn't look like a great time to be thinking about it.
Great, thank you. Finally, before going to Chris and Philip, Rick did a long, I think, well merited discussion of average inflation targeting. just Steve and then Kristin, any thoughts about the relevance for that in the ECB context? Both of you sort of dealt with it, but not as explicitly. So I just wanted to get you on the record on that before we go to Steve. Steve, before we go to Philip, sorry.
Thanks. Yeah, I think that I actually think it's complicated in exactly the way that Rick pointed out, which is that you need what I would call a look back period and a recovery period. You have to be explicit about those things over how long are you going to be averaging. And if you're not, the inflation expectation benefits just don't accrue. I do think that the major thing, as Rick pointed out, and he spent a lot of time emphasizing this, is the symmetry. And I'm willing to have an argument about whether or not to raise the inflation target. But I think average inflation targeting is a sort of second order thing, in fact.
Thanks for coming back to that, Adam. I wanted to raise this, but didn't know if we'd have time. My take on average inflation targeting is it actually falls directly in the set of comments I made. It made sense given what happened the last decade. Given these parameters shifted, we were slow to respond. You wanted to sort of catch up. But I worry it doesn't make sense if these parameters keep changing going forward. If you did have a shift in, say, inflation expectations that they increase, you don't want to then be doing a makeup strategy for a different regime, different set of issues, different structures. I think back to being nimble, being flexible. We don't know how the world will evolve. We don't know what's going to happen to Phil's curve, to inflation expectations. So committing yourself into making up for something that happened years ago may not be the right policy. And you could then trap yourself into being in a time inconsistent strategy. So I think that's a set of handcuffs that I'd rather not see the ECB take on. They have the tools now, go to a symmetric target for sure. But then just take each situation as it comes up. Don't lock your hands based on what mistakes that might have been made 5 years ago.
Can I just, Kristin, I actually do disagree with you here.
Yeah.
I agree with you. You have to be very nimble. Doing a average inflation target, in fact, people describe it as a flexible average inflation targeting. So there's no inconsistency with doing average inflation targeting with being nimble. The key issue here is that you basically are using expectations in a way that actually is desirable for you. And by the way, this is very similar to the issue that providing more information about the reaction process that a central bank uses actually also provides an automatic stabilizer in a similar way. But on the other hand, you actually have to be flexible. That's why, although I agree with your basic analysis, I didn't like your use of the word Taylor rule, because no central bank actually follows a Taylor rule. But you're right that those factors that are in what you wrote down as a Taylor rule are clearly important to central banks. So we're not quite in the same place on this.
Yeah. You know, part of my skepticism too is I have less faith in inflation expectations, how we measure them, the impact they have, the fact they've been stable. I've seen in the UK, if you ask people what inflation is, their answers are all over the place. They move quickly. I sometimes putting too much faith in adjusting your model and your framework in order to adjust people's inflation expectations feels like it could be very ineffective.
I, for what it's worth, I very strongly agree with Kristin on the skepticism about measurement and optimization of inflation expectations. Anyway, my deep thanks to Stephen Cecchetti, Kristin Forbes, and Frederic Mishkin for being so pointed, so practical, so insightful, and in our lightning round, so concise. Philip, you had said that you are in listening mode, so at a minimum, we'd welcome your saying what are the things you would take away to your colleagues, and we hope your colleagues also listening, to think about more, but also any responses you have to some of the specific points raised.
Okay, thank you to everyone for the excellent presentations, and also I did read the Q&A, which is, of course, you didn't get time to go through all the Q&A, but I'll try and think about the Q&A as well. I mean, I suppose it goes back to what I initially said is, first of all, we do have to kind of develop a common narrative of how we arrived to where we are. And there are kind of global dimensions to that, the structural changes that Kristin mentioned, but there are specific issues to the euro area, because of course we followed the global financial crisis with the euro area sovereign debt crisis, for example. We do have a monetary union, so the kind of dynamics of aggregate inflation do depend on the details of the composition of the business cycle across different countries. And we do have a different inflation history at this point. We've spent a long time with low inflation, and I don't disagree. There's all sorts of indicators of inflation expectations, and it's very important to differentiate between the expectations of the financial market versus firms, versus wage setters, versus households. But what is true is when we think about the dynamics of inflation, and in my own work, I wrote with some of my ECB colleagues a year or two ago a paper on the Phillips curve at the ECB. There has been this residual for the last number of years, and one interpretation of that residual is a slippage in expected inflation. And by the way, that in some countries, because there is backward-looking inflation indexation, for example, in wage setting, there's pretty mechanical ways which the path of inflation influences the future. I said before in other settings, that the logic of flexible average inflation targeting is crystal clear. But of course, as has also been evident from the panel discussion just now, how exactly that might make sense. There's all sorts of choices to be made. And let me emphasize again, it does interact with the history of inflation in a given monetary regime. And also it's very interesting set of comments between what is delivered by just symmetry versus what is delivered to also the additional commitments in a flexible version of average inflation targeting. So, of course, you can expect that the Eurosystem, all of these working groups, is studying hard the pros and cons of everything. I think at least one of you also advocated simplicity in communication, and we also have to think about that. I mean, I do think, by the way, a lot of, there was a lot of discussion of the intersection between financial stability and balance sheet policies. How do we tell apart monetary policy stance versus market stabilization functions? And for example, with PEP, we've been explicit that it has a dual function, it has both those functions. So I think maybe in just concluding, well, I'll come to climate change, but in concluding in terms of the overall issue, a lot of these are facing all central banks. And what we have to do is also distill it and apply it in the specific context of your area. On climate change, I mean, I would hope, it should be crystal clear, is that anything the ECB will do is in line with its mandate, where price stability is the primary mandate. But if there are policy choices that can be made without prejudice to price stability that support the economic policies of the EU, then that should be done. And of course, it's not, when we think over the next decade, for example, and that's global, there's going to be a lot of policies to support a pretty sharp decarbonization of the economy. That has all sorts of implications for macroeconomic behavior, for the dynamics of relative prices, and regardless of anything else, in terms of the kind of, especially if the transition is not smooth, if there's kind of a disorderly transition, we do think we need to be on top of that. But it should be clear that the lead is obviously with the European and national policymakers. But for us to absorb the implications for central banking is super important. So Adam, let me turn back to you, but let me thank you for your own comments and the panel for excellent presentations. Thank you.
Thank you so much, Philip. And again, our commendations to you and the entire team commitment at the ECB for listening, for engaging, and our gratitude on behalf of the Peterson Institute that you allowed us to convene this session and engage with our audience. Again, everyone, the remarks, the video, and the slides for all of our speakers will be available shortly, if not already. By shortly, I mean like literally very, very soon, on the Peterson Institute website with, of course, links back to the various individual speakers. So on everyone's behalf, please allow me to thank Philip Lane of the European Central Bank, Stephen Cecchetti of Brandeis International Business School, Kristin Forbes of MIT Sloan School of Management, and Frederic Mishkin of Columbia's Graduate School of Business, scholar policymakers all. This meeting is adjourned.